Hey, it's Jack. Tuesday morning, the Dow Jones is down again. As I mentioned yesterday, looking at Trend Point Software, it was bearish. Now it's at the point today where it's down below all three trend points, meaning there is no more support in the Dow Jones. It's kind of not, I wouldn't say free fall mode, but there's definitely a lack of buyers in everything in the market. Just to give you an example, I like to look at new highs when I'm going long and new lows when I'm looking for something to short. And today, I'm looking at the number of new highs and new lows, and there's just maybe 10 new highs. The way I count new highs, stock over $25, over 500,000 shares average daily volume, must trade on a major exchange and have options. And based on my criteria right there, we're seeing probably 5 times as many new lows as we are seeing new highs. Now, what's interesting is in every market, there's always going to be stocks that are making a new high. And there's always going to be stocks making a new low. But when you look at the sheer number of new lows versus new highs, you can see right now there is still a lot of pressure on the downside. Now, if there weren't that many new lows, we could maybe see where the stock market might kind of form a little bottom and then even have a rally, which we're going to have a rally before the end of the year. The fourth quarter is usually good. And we're going to need to see a big push by the institutions and hedge funds to get the market back up in tech where they want it. Dow, probably not so much. S&P 500, probably not so much before the end of the year. But tech is where I'm looking for the rally. All three indexes are bearish, but tech, QQQ, it's in the best of the worst shape of the three. So the other thing you got to look for is when this rally happens, start off with stocks that have been really beaten up, and start off with stocks that are making. If you got a stock that can make a new high in this market environment, it's really something to take a look at. Maybe put it on your watch list. Maybe even buy it. Because we're going to see that rally in tech. Now, I want to give you one really great tip today before I go, and that is a married put. Now, this is one of the best ways to protect any stock you own, especially when you're buying a stock in a rough market like we have right now. So the way this married put works is, let's say you got a stock you like, and let's say the stock is $100, and you buy that stock at $100, but you're afraid it's going to go to 95 or 97 before it goes to 120 or whatever you want. So you buy it at 100, and you're expecting it to go up, but you buy a put with a strike price of 100, the same price you paid for the stock, right? And you buy that with an expiration of about 30 days out. Now, this married put is going to protect you because if the stock goes down, the value of that put is going to skyrocket. So you buy a stock at 100 to protect yourself. You're buying insurance when you buy that $100 strike price put. And again, that put will go up in value if the stock goes down. So you're protecting yourself. When you buy that put at the same strike price that you paid to buy the stock, you own the right to put the stock into the market at the same price you paid for it. It's the number one insurance trick when you trade stocks. So watch that. Also keep peeps on the new highs and new lows going into the last quarter here as we are now.